Hey y'all, welcome to another episode of Investing Kev. In today's episode, we're taking a look at Chinese stocks September in review. I know we still have over a week left to go, but I'm busy next week and I think the major Chinese stocks have released their earnings report in September. We'll take a look at those companies as well as any relevant news to China or Chinese stocks overall. I've been busy with work, so the videos are not as frequent as they used to be, but I want to thank every single one of you for tuning in still and showing love and support. It truly means a lot to me. If you like my video, please give it a thumbs up, subscribe, and let me know in the comments what you think. Alright everyone, let's get started. The first stock is none other than NIO, ticker NIO. In Q2, NIO had deliveries of 25,059 vehicles, which is a 14.4% year-over-year growth. Their vehicle sales were at 9.5 billion RMB. This is a 21% year-over-year growth and 3.5% quarter-over-quarter growth. They had a vehicle margin of 16.7%. This is compared to 20.3% in Q2 2021. They say the decrease is attributed to increased battery cost per unit. Their second half of 2022 is critical to scale up production and delivery of new products. Their mass production of the ET5 will start in late September, which is pretty much now, and the ET7 set sail to Europe in August. In Q3, they expect 31,000 to 33,000 vehicle deliveries. Looking at the next stock, entertainment giant Bilibili, ticker BILI, this is what they had to say. They had total net revenues of 4.9 billion RMB. This is a 9% increase year over year. Their average monthly active users were at 305.7 million people. This is an increase of 29% year over year. Their average daily active users were at 83.5 million. This is a 33% year-over-year growth. Their average monthly paying users are at 27.5 million people. This is a 32% year-over-year. They believe that the largest impact of the pandemic is behind the company. They increased their ever-growing content in different formats, such as story mode. This grew user base and increased user engagement in Q2. They increased their ability to monetize converting users to paying users, which was seen in Q2. And they grew their advertising market share in a rocky economy. During times like these, advertisement revenues usually decline. The next stock is Up Fintech, ticker TIGR. Their total revenues were at 53.5 million US dollars. This was a decrease of 11.2% year over year, but an increase of 1.6% quarter over quarter. This was attributed to macro environments remain challenging. Their weak market performance slowed trading activities and asset growth. In Q2, they added 27,900 funded accounts. More than 70% of those accounts came outside of China. Their total number of funded accounts were at 731,400 people. This is an increase of 38.2% year over year. And their average inset inflows of new clients in Singapore in Q2 were greater than 9,000 US dollars, and they had total net assets exceeding 1.5 billion US dollars. And the final stock is none other than traveling giant Trip.com, ticker TRIP. Their net revenues were renminbi 4 billion, which is about 598 million US dollars. This was a decrease of 32% year over year and a decrease of 2% quarter over quarter. Their net income was at 43 million renminbi, which is about 6 million US dollars. This was an increase from 1 million renminbi in the previous quarter. Their local hotel bookings increased over 30% compared to the same period in 2019, and their air ticket and hotel bookings on global platforms increased over 100% year over year. Right now, they are focused on operating efficiency and conducting prudent cost controls. I want to take a look at a few news articles that impact China and Chinese stocks. Last month, there was huge news in regards to auditing as China and US agreed to auditing standards. The US would still have to ensure Chinese companies are properly audited. Well, that happens to be this month, with consulting firms from US heading over to Hong Kong to probe Chinese stocks. If the team is not happy with what it finds, then the roughly 200 Chinese companies listed on the American markets could be forced to delist as early as next year. Experts say that the agreement is a sign that neither side wants to see a financial decoupling between the world's two largest economies, but they also stress that the deal is just a first step in resolving the issue. The team is expected to focus on the auditing work of the big four accounting firms, PwC, Deloitte, KPMG, and EY. They will audit around 130 US listed mainland companies, or about 80% of the total. I personally believe that most of these companies will adhere to the standards and be okay. The next news is about Taiwan. Taiwan is always going to be the news, especially with Biden wanting to provide military aid to Taiwan like he's doing with Ukraine right now. This is great for defense stocks out there, but it's not good news for Chinese stocks, and it would be a lose-lose situation for the entire world if China and the US got dragged into a war. In a recent Bloomberg article, China says it has patience needed to bring Taiwan under control. Taiwan compatriots want to be a part of China, officials say, and a recent poll in the Democracy shows cooling views of Beijing. China said it has the patience to someday bring Taiwan under its control, partly because compatriots there want it to happen. More and more Taiwan compatriots realize the future of Taiwan lies in national unification. Xi Jinping, who is currently 69 years old, may spell out his plans for Taiwan at a key congress of the ruling Communist Party starting October 16th. This is when he's expected to secure a president-breaking third term in power. He'll describe unification as a long-term goal. And the final news is about European business. From this Bloomberg article, China loses allure as European firms rethink investments. Ideology is currently trumping economics in China. and the future investment from Europe can't be taken for granted. The article states that recent Chinese policy decisions mean that the country is now seen as less predictable, less reliable, and less efficient, according to a report published Wednesday by the European Union Chamber of Commerce in China. This has led to a loss of confidence in China, and firms are increasingly looking to shift planned or future investments to other markets that are seen as providing greater reliability and predictability. In countering these points, Wang Wenbin, who is a foreign ministry spokesman, said in the first 8 months of this year, European countries rank among economic groupings that have had the fastest growth in direct investment into China. And the numbers do back that up. Investment from the European Union into China was up 15% in the first half of 2022 compared to a year ago. We definitely don't have a timeline when the zero COVID policy will be lifted, so time will tell. The market is just absolutely rocky right now, and Chinese stocks are absolutely affected. Are we or are we not going to be in a recession? Are we currently in a recession right now? The White House says otherwise. How does inflation continue to impact everyone, and how does global affairs turn out? Dollar cost averaging is my best friend right now as I'm accumulating stocks like NIO, Alibaba, and Bilibili at these prices. With that being said, I hope this video was helpful, and let me know in the comments if you're invested in these companies. What do you think about China and Taiwan? What do you think about the auditing news? Let me know. As always, thank you for tuning in, stay safe, and I'll see you all next time.